Welcome everyone to the Planet MicroCap Showcase Virtual. I'm your host, Robert Kraft. And now presenting at our event is Rene Gorham. He's the president and CEO of BioSyent. It's a publicly traded company. The symbol is RX on the TSX Venture. Rene, take it away.
Thanks, Bobby. It's a pleasure to be here with you today. I wanted to present BioSyent Inc. We're a Toronto, Ontario, Canada-based specialty pharmaceutical company. I just want to draw your viewers and listeners' attention to our forward-looking statements disclaimer. So let me tell you a little bit about BioSyent. As I say, we're based in the Toronto area. We're a profitable growth stage specialty pharmaceutical company. We focus on in-licensing innovative assets that we source around the world. We bring them to the Canadian market. We work them through the regulatory process, and then we commercialize. So we do all of those commercial functions that you would expect to see in a pharmaceutical company. We source these products typically outside of Canada, in essence, looking for unique and differentiated products that we think address an unmet medical need or address a medical need better than the existing standard of care or options that are available in the marketplace. We target products that are late stage, so we're not typically engaging in new assets that have got a lot of development yet to go. And we don't invest a lot in R&D. We have done some investment in R&D over the last couple of years as we've done some life cycle initiatives on our largest asset, and I will speak a little bit about that, but I would call our investments more development than they are research. So this is what gets us out of bed in the morning, gets us excited and focused on patients, consumers, and making an improvement in their lives. We get a lot of feedback from people that use our products and interact with our products. And we also assist healthcare professionals in treating their patients. So BioSyent at a glance is essentially this slide here. We're a profitable company. We've had 49 consecutive profitable quarters. Our last full reported year, fiscal 21, we did just under $29 million in revenue, just under $9 million of EBITDA, EPS at 49 cents, and a return on equity of 21%. So a cash generating asset light business model. We've got a couple of products that are in launch stage. I'll touch on those in a couple of minutes. We've got 2 new products coming to market next year, and another one that's part of our life cycle strategy being developed and will be available for market likely in 2024. And our current portfolio of products that we can control and influence without any new assets being acquired or in license supports a top line of over $50 million in revenue. We've got a strong balance sheet. We've got to, as of September 30th, we had just under $28 million in cash. We've built a platform to commercialize products. We have a national sales force, 9 products are approved, and we have our own sales force. So this is not a contracted sales force as you might see with others in the industry. These are BioSyent people, and we've got a long history of presence in the market across Canada. We do sell some of our products to customers outside of Canada. We think of that as kind of incremental revenue on assets that we own outright. As I mentioned, we have a strong balance sheet. We did our last equity financing 20 years ago. And in fact, in the last 4 years, we've been buying back shares and reduced our fully diluted shares outstanding by about 15% during that period of time. And if you can look at our trading price versus the cash that we have on hand, we've got more than a quarter of our market price is in cash or near cash on the balance sheet as of September 30th. We've got an experienced management team. As insiders, we own about 25% of the company, and so we've got some consistency in the personnel that we've got and a real focus on looking for quality assets and what I would say is not doing a deal for the sake of doing a deal when looking to expand our portfolio. There's a quick look at our brands. We are, as I mentioned, in the process of adding 2 products to this list of that you see here. Those 2 products will see market within the next 4 to 5 months, one of them before the other. So this is just a quick snapshot at the last 10 years of growth at BioSyent. It's a demonstration of persistently staying at the commercialization process and licensing new assets and taking them to market. This is an example of steady wins the race. I think that would be the way to characterize BioSyent and our management. Maybe a little atypical of what you would normally see in the MicroCap universe. So the largest contributor to our revenue is a brand known as FeraMAX. It's an oral iron supplement in Canada. It is the #1 recommended oral iron supplement amongst pharmacists and physicians. And this is now for 7 consecutive years. We own this brand outright and have a long-term supply arrangement for manufacturing. And we've just made some changes to formulation over the last couple of years and see this as a great platform, a great brand platform to enhance the product line for improvement of iron health of all Canadians and in those markets where we sell this product globally. So as I mentioned, we did some innovation around the formulation of this product. We've had this product in the market now for over 12 years. We introduced the new FeraMAX PD platform. It's a patented delivery system of polydextrose iron complex. And as I mentioned, we are using this as a platform for innovation. So we converted our existing products in the market to the new formulation in 2020 and 2021. We had considerable growth on the back of making those changes. And we're in the process now of preparing the next FeraMAX product for market, which we will launch early or certainly in the first third of the year in 2023. So we have a life cycle strategy on FeraMAX that goes beyond just identifying new products for new markets that we think are underserved. The next product we see in the market will address an unmet medical need that we think no product that is in Canada will address today, including FeraMAX. So we see it as a net incremental opportunity. We have yet another one of those coming along in the FeraMAX franchise, and that product should see market in 2024. In addition to that, we're doing a number of things to improve and further engage our customers, healthcare professionals, pharmacists, and patients and consumers. Generally in Canada, if you're new to the Canadian healthcare scene, products that are prescription cannot be promoted directly to patient. In the case of FeraMAX, it is regulated as a natural health product, and we can communicate product benefits and actually sell the product directly to consumers and patients here in the market. A couple of years ago, we launched Tibella, essentially right in the heart of the COVID environment. That product is a menopause hormone therapy for vasomotor symptoms. It is still a growth stage product. We've established it in the marketplace. We've had outstanding feedback from healthcare professionals. It's been adopted as part of the recommended standard of care amongst the Society of Obstetricians and Gynecologists in Canada, but we still think there's a considerable amount of growth left with that asset. We launched Combo G-Sick, which is an analgesic combination of acetaminophen and ibuprofen, the first such product in Canada. That product was launched, or the promotional launch started at the beginning of 2021. It's a very competitive market. We've made some progress on that. It's been progressing slower than expected, but recently we've seen some considerable promotional effect from our efforts in the market. We have a new women's healthcare product that's coming to market. It's approved and will be launched in the April-May timeframe. That will be a new asset that is promoted to specialist markets, obstetrics and gynecology, and over time also to those healthcare providers, family medical offices that have a kind of a female-centric office. So we're quite excited about that asset. It provides a clear benefit to the patient, but it also is going to help the healthcare professional in managing this patient population. The heartbeat of a company such as ours that does not do typical research and development and is in the pharmaceutical industry is acquisition or in licensing. So we've got an active activity right now in both of those areas. In the last 12 months or so, we've looked at a number of assets for acquisition. We have not pulled a trigger on anything at this stage. So if you looked at our portfolio, you would think of us as more focused on in licensing. We've got in-license deals with US partners, European partners, but we have worked on assets from Japan as well. I think we've got some discussions going right now, some negotiations on some assets from there. So we'll look for wherever those assets are available and are unique and differentiated at late stage, so that we can bring them to market in Canada on a reasonable time frame. Just a quick look at our most recent 9-month results. So our fiscal is a calendar, so these are September 30th results. You can see sales of just over $20 million, EBITDA just under 6, and the net income after tax just over $4 million. A couple things to point out here. At the beginning of this year, we discontinued a couple of assets, products that we had in the market. We returned them back to the licensor. We didn't see them fit our portfolio well, and as a result, we've had a small decline on the top line. The growth assets that I've just been talking about, we think are going to comfortably replace the revenue that was represented by those, and then over time give us essentially a better profit margin and operating profit on those assets when they reach a more mature stage. Our core business in pharmaceutical is in Canada is up net, and our challenge with the top line has also been with our sales to international markets. So this is just a quick look over the last 8 quarters of how our operating results have been translated through to earnings per share. In the last 12 months, we're at TTM, I should say, we're at 49 cents, which is very consistent with last year's full year 21 results. That TTM compares favorably with the prior 12 months. So I mentioned earlier that that we have a strong balance sheet. We have a cash position you can see has been building. This just shows you over the last couple of years, trailing 12 months ending September 30th. One thing to keep in mind is during this period of time, we've been aggressively buying back shares. So the cash growth in the trailing 12 months to 22 don't look that significant, but cash from operations in that period was $4.7 million, and we deployed over $3 million in buying back shares during that period of time. Overall, our execution of strategy has led us to a return on equity of 19% in that 12-month period. We like that metric as it keeps us focused on quality rather than just growing the top line. Keeps us focused on quality assets that we think have a reasonable expectation of delivering a strong return on investment. And as we are in the in-licensing business, we are doing financial modeling on assets that can be quite a ways from market. And so we've set a high standard for what our internal rate of return would be on new in-licensed assets. So I do get asked with some frequency, Renee, you've got a capital light business model. and you're cash generating, what do you intend to do with your cash? So at $28 million cash, no debt on the balance sheet, we have operating lines of credit available to us. And the best way to answer that is to say that that our capital allocation is directly linked to our strategy. So our strategy is about growth, both on the top line and profit over time, diversifying our portfolio with new revenue streams, new assets, new products, and then a decision-making structure that is about the long term in our business. So the first dollar that we spend or will spend is in growing our existing asset base, and the next dollar is in licensing new assets and then investing in growth of those products. And if you look at our P&L over the last couple of years, you can see a significant emphasis on investing in growth. We've built our sales force out. We've made further commitments to marketing investment, and these are all things that one does when you are launching new products. The ratios that you might see when products get to maturity are different than when you're in the earlier stages. So we've committed to growth and feel strongly that we're a growth story. However, because we've been cash generating and essentially we've had an outsized amount of cash on the balance sheet to our business, we have initiated buying back shares in December of 2018. I've got a little bit more information on that on the next slide. So we've been buying back shares now for 4 years. In just this year, we've bought back just under 425,000 shares, deploying about $3.3 million. Our cash position through all of that activity and launch and investment and growth has stayed strong, and the board of directors adopted a new dividend policy earlier this year, and on October 12th declared the company's first quarterly dividend to be paid in December of this year. It's a 4 cents a share quarterly dividend, which works out to about $500,000 per quarter that we're going to be paying back to shareholders in addition to our share buybacks. So some stats on our NCIB buying back shares. As I mentioned, we started the program in December of 2018. In that time, we've bought back 2.2 million shares. We've deployed over $14 million in capital and reduced our fully diluted shares outstanding by 15% during that period of time. And a quick way to measure whether we're getting a decent return on investment is to look at what our earnings per share would have been on a trailing 12-month basis with and without buying back shares. And the answer to that question is about a 16-17% benefit in terms of enhanced value on a per share basis. The other thing to mention here is that we suspended the use of stock options as a form of equity compensation within our company, and we've replaced that with restricted share units. And what we're doing there is, rather than having a dilutive effect on RSUs, is that we are using our strong balance sheet and cash position to buy BioSyent shares in the open market. This is in addition to our NCIB activity, which buys the shares and retires them. We're buying shares, I should say, to hold in trust to eventually pay those shares back out in form of our obligations under the RSUs. So what does our road forward look like? Well, we have a strong product portfolio. We've got 2 products coming to market within, I guess, the recording of this presentation within the next 5 or 6 months. We've got 2 additional growth assets coming. We have new FeraMAX life cycle initiatives. We see, strong top line growth in the business. We are investing in promotion, so sales force and marketing expenses. We see that will have some short-term impact to our typical profit ratios. With an in-licensing program with several assets in the deal funnel and expect some news in that regard. And we're very focused on running a disciplined business. We intend to be around for a long time, running a profitable business, and standing behind the quarterly dividend, which we just initiated. So given the economic environment that we're in right now, we think it's a tough environment. Obviously, rising interest rates, but our business is profitable. We are well positioned in a high interest rate environment to see potentially some assets shake loose from those that have leverage or debt on their balance sheet. And we think that that's a good place to be for us. And we look forward to sharing with those that are interested our success in building long-term value for shareholders. I'll leave it there, Bobby.
All right, very good. Thank you, Renee. So my first question for you is, when you're looking at, potential products for acquisition or in licensing, for those that aren't aware or haven't been following the BioSyent story, what are some of your criteria? And then what was the thought process with some of the products that are coming online in 2023 and 2024?
Sure. So the things that we look at are which patient or healthcare professional would it serve? So who would our call target be for our sales organization? And we want to see, the competitive environment and whether the product itself that we're considering would address a need and that give us a point of differentiation in the market. That's kind of the first place that we start. And we do get asked, are you specifically focused on women's health? And we have a number of women's health assets. Ferromax is primarily a women's health asset in that its iron is consumed over 80% by women. But we're not exclusively focused in that area. We are actually working on something right now that will take us into a new area. And partly this is around our focus of diversification. So we don't want to just diversify in number of products, but what our call points are and how we go about promoting. We have other metrics. We look at intellectual property, the competitive environment, as I mentioned, who is in the market, what their assets are, and what their point of differentiation is. Can we really offer an improved solution to doctors and patients? We have, after all of that, then we've got a financial modeling that we look at the assets over a 10-year time frame in terms of what we expect to invest to grow the product and get it into the market, and what we should expect in terms of long-term returns on investment. So we've got hurdle rates for payback and internal rates of return, and an EBITDA over the duration of the asset.
Very good. My next question for you, another two-parter. I do a lot of two-parters, so here we go. Here's another one. What would you say are some of the industry's tailwinds that can explain the growth that you're hoping to see for the company's product set? And then on the other side, what are some of the headwinds that could impede some of that growth that you're hoping to see?
Yeah, so they're actually, those two are linked. I mean, the tailwinds generally are that we're in the health products business, and we can throw up a mission statement that says make life better. I mean, it's not there are going to be a portion of consumers and healthcare professionals that are always looking for innovation. And so that to me is a tailwind generally. It is a competitive industry. So that, specifically focused around us and the assets that we're trying to commercialize. It's very rare that we go into a market that doesn't have any competition. In fact, we don't do that. It just doesn't exist. So as much as our industry is interesting and can provide good financial returns on investment, that makes it attractive for others to get involved in the process. So I think even in an inflationary environment, it isn't necessarily the last dollar that gets cut, but it is going, your decision on a healthcare product is going to survive that next piece of jewelry or your new car or and I think that gives us an advantage. to the extent that our products are influenced by payers over time, there is some stress on the healthcare system in Canada, as there is generally everywhere. But in Canada, we've seen that in terms of the funding for hospitals. It's socialized medicine, so it's paid for by the government. And I think there's been I'll call it a professionalization of purchasing in the hospital infrastructure, which has caused us to kind of back away from that as a market that we have a lot of interest in. So I think those are the things that we think about over time.
Very good. Another question I have for you, you mentioned competition specifically on the product side, but, I've done a number of interviews with companies that are doing, are trying to deploy a very similar model as BioSyent. Have you been seeing more competition in the potential acquisitions or licensing deals that you're hoping to do?
Yeah, I get a question of this nature a fair bit and over time. And I would say my observation is that it's almost like a game of whack-a-mole. There are new players and new faces and new corporate entities, and there are many people in the industry in Canada specifically that have experience and hope to leverage that experience. So you see new companies kind of popping up and growing. Likewise, my observation has been there's been a tremendous destruction of shareholder value in our industry in the last 5 to 7 years, and those companies will remain nameless. But I think short-term decision making, expedience, doing a deal for the sake of a deal so you can say you did a deal. I think that kind of short-term thinking has put a number of players in the ditch, or they don't exist anymore because they've been bought out. So I don't think there's any fewer competitors. I think this is where our approach maybe puts us in a good spot with some patience, and we've got a cash generating business, so we don't have to do things that are kind of questionable just so that we can look like we're doing something.
Very good. All right, my final question for you here today, and you kind of already alluded to it in your final statements of your presentation, even your last slide right here. But I'm asking this to every company that's presenting here. We are managing through tough markets, right? So what is BioSyent doing? What measures is the company taking to manage some of the macroeconomic pressures that are currently affecting most microcap companies across the board?
Yeah, that's a great question. Well, a number of things. So there's supply chain, there's a kind of a disruption in labor market, I would say. I'm just kind of identifying the issues and then kind of what are we doing about it, and then interest rate and inflation. So on supply chain, we have leveraged our balance sheet to take a larger inventory position so that we don't suffer as much disruption when there is short term. And we've seen this even with typically strong manufacturing partners that have had some trouble in getting the labor that they needed to manufacture and supply goods. So, increase in our inventory, that also has helped us somewhat in terms of hedging against inflation to buy forward, in essence, to make sure that we're hedging inflation. And the other one is around interest. I mean, we are in an enviable position where we've got a strong cash balance, and actually that puts more money in our pocket, although it's not our business, is to earn interest income on our cash position. But whereas others are staring at large debt positions that are coming due over the next 6, 12, and 18 months, in that environment, we can focus on our business, which is looking for these assets and commercializing them, and not having to fret about how we're going to manage a growing interest rate.
Very good. All right, Renee, we're there. Thank you so much for your presentation and answering a few questions here. And for everybody tuning in, thank you for watching.
Great. Thanks, Bobby. It's been a pleasure.
Thank you.